Investors are curious about what the Federal Reserve will do in 2024. Pretty much curious about that going into every year. Joining us now, Peter Boockvar, Bleakley Advisory Group CIO and a CNBC contributor. So, Peter, I guess we can sum up 2023 in some sense as bad things that we thought might happen that didn't happen, whether that was stubborn inflation, a recession, and also the Fed feeling as if it was going to have to force the economy really into a stall in order to get inflation lower. Where do you think that leaves us looking into next year?
I see a lot of potential big-time trade-offs next year. Fed's going to cut interest rates next year, but what if long-term interest rates actually resume rising again? Because the market views that as the Fed pulling back from their inflation fight. The whole worry about excessive Treasury borrowing is not going to go away. What if the Fed only cuts 3 times, as the dot plots imply, but the market's expecting 6? There's a trade-off there. And if the Fed does cut 6, maybe that's because the unemployment rate is going to 4.5 to 5. So I think there are a lot of pushes and pulls here that I think investors need to be careful about. And what I find also amazing is that one of the big lessons of the 1970s was a Fed that got complacent after inflation fell after initial spike, and then inflation resumed rising again. And everyone just assumes that this battle against inflation is won because we're going to go back to this 2%. No, what wins the war on inflation is a sustainable period of time of inflation around 2%, not a few months on the downside of an inflation spike.
That is certainly true, and I think it'd be hard-pressed to suggest that Powell, who's been talking about the hazards of the 70s experience for a couple of years, is unaware of that. I guess really everything you mentioned that is one of these dangers out there, and I totally agree that things could go astray from what the market is now expecting and pricing in. But if inflation does continue going in the right direction, it's the escape hatch for all of it, isn't it?
For sure. I mean, that's the big pain reliever, call it, is to get inflation around that 2% and to keep it there. And that obviously gives the Fed a lot of flexibility. I mean, it was low inflation for the 15 years leading into 2022 that gave license to all these central banks to experiment with negative interest rates, zero rates, and all this QE. So if you go back there, in terms of the level of inflation, well, it obviously gives them more flexibility. I just don't think it's going to be that easy to have a spike to 9% inflation and just magically come back to 2-ish and stay there. I think it's going to be much more of a bumpier landing. And I'm still a believer that the sustainable rate of inflation over the next 3 to 5 years is going to be 3 to 4, not the 1 to 2 that we had pre-2022.
Yeah, I mean, it's interesting because historically stocks are generally okay with a 3 to 4. I mean, yeah, it just depends on what happens in terms of monetary policy and market yields in response to that, to your point. Now, I would love to zero in on this idea that the market, quote, expects up to 6 rate cuts next year. Basically a percentage point and a half of rate cuts. Just because the Fed funds futures kind of dangles that out there in the latter part of next year, it's unclear that there are lots of human beings walking around saying we're both going to not have a recession and the Fed's going to cut that much next year. It seems like a kind of a what-if tail scenario out there in the absence of any other way of quantifying what might happen. Once you know the Fed's next move is likely lower, you start to over-extrapolate if you're the Fed funds futures market. Isn't that true?
Absolutely. And to be clear with the Fed funds futures market, it's only telling you what they think today. Yeah. Their opinion can change tomorrow. Their opinion can change again next week. So it's not a predictor. It's how it's, as of with today's information, how it's priced in. And you're right. And that gets to my point about trade-offs. If they only cut 3 times, you can look at that as a Powell looking at a modest tweak to the reduction in inflation with growth staying resilient. If they cut 6 or more, that's because the economy is still going to run into trouble. And with the economy, we still have to understand that the big rise in interest rates in a very condensed period of time still is working its way through the economy. There's about $700 billion of investment-grade debt that needs to be refinanced in 2024. There's about $500 billion of commercial real estate debt that needs to get refinanced in 2024. So there is still this refinancing wall that we have to deal with in 2024. And 100 to 150 basis points of rate cuts is not going to magically fix that.
Yeah, Peter, you mentioned kind of the prospect of the Fed winning the war on inflation. I'm curious to that effect, how you think about them winning the war on the lag effects that we've talked about with regard to just this historic rise in interest rates and the overall financial tightening, because it appears just based on what the market's doing, according to the Goldman Sachs Financials Tightening Conditions Index, that things have actually flipped and now they're easing just based on what the market is doing. So, have they won the war against the lag effects as well?
Well, that still is going to play out. I mentioned the 2024 maturity wall. There's an even bigger one in 2025, and then it goes up again in 2026. So if I'm right, and to Mike's point, 3 to 4% for a period of time was more of a normal inflation rate before we got to 1.2 and the markets did okay. The difference this time is that it comes after 15 years of zero rates and 1 to 2% inflation. So to your point, that's where the adjustment still has years to play out, and that I think it's still very premature to assume that we've landed just very smoothly, because the economy still needs time to acclimate to this higher rate environment. And those balance sheets that are off sides are going to feel the impact. And that's why 2023, we sort of gotten this pass with the sharp rise in interest rates, because not everyone's debt came due. Not everyone had to refinance. But as the days, weeks, months, years play out over the next couple of years, if rates stay high for a while, albeit maybe lower than we are currently at, there's still a large amount of debt that needs to refinance. There is still a lot of money that needs to be allocated to interest expense and less so to other things as a result.
Yeah, no escape of that, Peter. Appreciate the time this morning. Happy New Year.
Thank you. You as well.